And then we hear something about them buying corporate debt. What are they doing out in Europe at this point?
Well, they're buying 80 billion euros per month, up from 60 billion just just a few months prior. So they're trying to engender inflation. For some reason, these Keynesians believe that getting inflation at 2% is somehow better than 0 or 1%. And the notion that they could just hit 2% and just stop is ridiculous, Dave. So they're going to hit 2% sometime in the future. Inflation is not about people working. It's about the market losing faith in a currency's purchasing power. That's going to happen. It's happening. Once that occurs, they're going to go from 0 to 1% to 2%. By the way, it's not like they're in some violent deflation at this time. That's some kind of panic that they need to start worrying about buying corporate debt and getting the money supply, which is already booming. I think the M1 in Europe is up almost double digits. So, if M1's rising at 10% and you have a 1% inflation rate, why do you need now to go buy corporate debt and get inflation at 2%? But they're going to get inflation to 2%, I have no doubt in my mind. And the same thing in Japan and in the United States is already above 2%. But what happens when it goes to 2%? They're going to say, okay, inflation is at 2%. It doesn't just stop there because, as I said, it's not about people working. Inflation is about the market losing faith in a currency's purchasing power. So it's going to be going to 2% and 3% and 4%, and that's going to cause Kuroda and Draghi and Yellen to finally slam on the brakes. That means selling assets, raising the Fed funds rate, raising the overnight interbank lending rate in Europe and in Japan as well, and even in the Sino scam artists that run Shanghai. So you're going to have rising interest rates. They're going to have to rise violently, and when interest rates rise violently, the whole entire world will collapse in unison, concurrently. So, for example, in Japan, they have their 10-year note trading with a negative sign. In fact, there's $7.8 trillion worth of sovereign debt trading with a minus sign right now. Corporate bonds are being issued with a minus sign in front of it. What happens when central bankers have to back away from their inflation strategies and they have to switch from inflation to deflation? The Bank of Japan owns in 90% of their equities, the Nikkei 225, 90% of those equities, they're a 10% holder. Bloomberg just did a study the other day. So every asset is every sovereign debt market's in a bubble, which means by virtue every asset class that's priced off that supposed risk-free rate is in a bubble. And when central banks back away from that, it's all going to collapse. And I'll tell you this, I'll end with this very long-winded answer. I'll say this. You're getting inflation. You're not getting any growth. The only inflation you are getting mostly manifested is in asset prices. Watch out below. This is the most dangerous time in the history of investment.
Now, do you think the Fed had this emergency meeting with the president, the vice president, bankers, finance ministers? I mean, what do you think they were talking about at this point?
Well, they were talking about the dollar. They were talking about the dollar. They were saying, listen, I said this, my last appearance on CNBC, which is now over a year ago. They don't like somebody who comes on and tells you the truth, I guess. I was on CNBC and I said, listen, I told to Kelly Evans, I said, listen, you can't have a unilateral increase of interest rates in the United States when you have Draghi and Kuroda going crazy, and also the People's Bank of China going crazy, doing backflips to generate more quantitative easings and more negative interest rates. It's going to cause the dollar to explode, and it did. And they agreed, I think 2 weeks ago, they said, listen, this is enough. We agree. Mr. Yellen, you have to back away from raising interest rates. Wait until we at least stop going further and further into QE before you raise interest rates. And that's probably what happened. The dollar went from 99 in the Dixie down to 94, and I think that's probably where they want to keep it. I don't think the Fed is going to do anything with its announcement tomorrow.
So you don't think the Fed is going to raise their interest rates, 6 times? Well, then they said, 3 times. So you don't think this is going to happen?
Well, I don't think they said 6. They said, first they said 4 times. They said 4 times in 2016. They did 0 times in 2016. They did 1 time at the end of 2015, the very end. The markets fell apart. The dollar screamed higher, and the markets fell apart. And then they had the central bankers walk back on their 4 threatened rate hikes. And then the market's now approaching all-time highs, so now they're starting to feel more empowered. and they have the temerity to come out and talk about the rising rates, but I don't think it's going to happen. Yellen runs the Fed, and Yellen is an uber dove, and I think they stay at where they are, which is, I think, about an effective Fed's fund rate's about 35 basis points. I think they stay there, and especially in the fact that you look at economic data, Dave. They have a little bit of inflation. That's true. But where is the growth? I mean, we went from a 2% annualized growth rate since the Great Depression ended. We had a 1.4% GDP print in the United States in Q4. We're now down to something like 0.3 in Q1, according to the Atlanta Fed. And everybody, even the most ebullient of market forecasters, says its GDP is going to be somewhere south of 1%, have a 0% handle. And if you look at the very early data from coming out on Q2, it's been all bad. The manufacturing sector looks like it's rolled over again in April. And this is in spite of the fact that Chinese debt is booming, and they're raising their levels of debt. They already have 30 trillion in debt, which is 300% of their GDP, and they're forcing more and more loans on the market. They had a huge increase in loans in February and March, in January, February, March, and their growth rate in debt is now at a 40% of GDP annual rate. It's just unsustainable. And what is this debt issued? To build more empty cities and to cause more speculation in Chinese rebar. It's a joke.
Right. It's funny. People are very confused at this point because we see the unemployment numbers down at 5%. They were at 4.9. And, the president is out there telling us that everything is fine. But we see, like you said, manufacturing, retail, all declining. How can we have two opposites happening at the same time?
Well, my theory is that if you look at, and my theory is blown out by productivity, which is actually non-existent, you have a very robust job market in part-timers and in full-time jobs that are in the service sector. So bars and restaurants, they call it the gig economy. So bars and restaurants, part-time healthcare workers, there's really no productivity there. So the productivity comes from capital goods. It comes from the manufacturing sector. The manufacturing sector is dead in the water. And that's why you're getting, seemingly robust, 5 Uber drivers are hired to work part-time. And they're all counted as a full-time job, as they counted as a regular job, according to the BLS. But if you're looking at real, goods-producing jobs, they're not there. That's where the productivity is. So, every other data point shows you clearly that the economy is stalling and rolling over. The only thing that the Keynesians like to point to is that look how great the job market is. But as I just explained to you, aggregate hours worked is not really moved anywhere. And that tells me empirically that there's a lot of part-time workers, and there's no productivity in the jobs that are being created. So they're very low-paying, low-grade jobs, and that's why you're seeing that dichotomy exist.
Now, in the start of this year, the market was way down, and people were like, oh, my God, the market's crashing. And then it seems like it was pumped up once again. And here we are in April where it went over 18,000. And we're hitting all-time new highs. But Bank of America is reporting that investors, they're getting out of the market, and was it like 11 or 12 consecutive weeks that the smart money is getting out? Do you think this market will continue on the way it is, or do you think something's going to happen going forward?
Oh, something very, very nasty is going to happen going forward, Dave. As I said, you have almost $8 trillion of sovereign debt trading with a negative yield. And you have asset prices that are totally decoupled from economic reality. So if you have GDP, which is at zero, and you have market values that are record highs, you look at total market cap to GDP, price to sales, median PE ratios, and we're in the stratosphere, totally decoupled from economic reality. So what I think is going to happen is we're going to be successful in creating inflation, and central bankers are going to have to stop buying everything that's not nailed down. And then you're going to have an epic crash such as the world has never seen. Now, I don't know what's going to happen today or tomorrow because they're still going crazy. China is still issuing debt at a madcap rate. Kuroda will announce some more easing measures, maybe double down into negative territory, and issue loans. These commercial banks, these private banks, have lending facilities from the central banks. Well, now they're going to get loans from the central bank with a minus sign in front of it. So they take money out and they have to pay back less. They're getting paid to borrow money. I mean, where does it all end? It's going to end with inflation. And by the way, these central bankers, when they offer these loans for a negative with a negative yield, and these commercial banks, they don't go out and lend money to the people, to the corporations, to the private sector, because the private sector is debt saturated. We are a debt-disabled economy across the globe. So what do these bankers do? They speculate. They buy real estate. They buy stocks, and they buy bonds. So when all this ends, and it's going to end not badly, it's going to end with a catastrophe, with chaos. When that ends, and that'll end, you have to answer this question. When will it end, Michael? It'll end when inflation rises above central bankers' targets. And then they're going to be in a mad dash to get out of what they've done, to unwind the stimulus, but all they have left is an unwinding avalanche of asset bubbles across the globe.
Now, there are some people that say that the Fed is getting ready to implement QE4, that they're going to resort to printing money. Do you think they're going to be going down this path?
I do. It's obviously not going to be in April. I mean, it's not going to be in the April meeting. I think once we enter back into a recession, and from my calculations, we're very close, and even according to the BEA, the Bureau of Economic Analysis, we're close. We're going to have a zero handle. Perhaps if you calculated inflation correctly, it would be a minus sign. So that's one quarter negative growth. Q2 doesn't look like it's starting that well. China's debt boom, was really pressed on the accelerator in January, February, March. They have to ease off because they know that their currency is going to collapse if they keep up that rate of debt. So we're going to have probably a downturn in oil prices and a downturn in commodities, downturn in the market in Q2. That'll bring us into an official recession. And then if we go into an official recession, what is the Federal Reserve going to do? I mean, what are they going to do? Take back the quarter-point rate hike that they just implemented in December 2015? No. I mean, if they do that, does anybody think that is actually going to solve the problems that are evident in the United States and in China and Japan and in Europe? Not at all. So I believe eventually, not obviously imminently, but eventually they're headed back into QE.
Now, for those people that are watching the market and watching the economy, what are some of the signs that everyone should watch out for that things are actually getting worse?
Well, right now I have my eye on the U.S. dollar. I'm very closely watching the U.S. dollar at 94-ish. It bounced there 6 times in the past year. I think of a tremendous rise in the dollar from here. Back up towards 99 would cause a real epic short-term market correction. However, if they can get the dollar lower, you might be able to continue this mirage for a few more months or maybe even a few more quarters. But I think eventually, and I say eventually, I'm not talking about years, I'm talking about quarters, they're going to hit their inflation targets. That's the real risk. So if you want to look at CPI, or you look at the Fed looks at this core PCE, if you start seeing that go north of 2%, and that's, by the way, regardless of what's happening with the economy. So what I think people should look out for is stagflation. If you see continuation of slow economic growth and inflation targets rising above 2% on the core PCE and CPI, then you know, and it's rising, not just there for a month and then falling back, an inexorable rise, an increase in core CPI and core PCE, then you know the Fed is going to have to act. And if the Fed starts to act, and that goes the same thing for the ECB and the BOJ and the PBOC, if these central banks achieve their targets and then start moving those rates higher, then watch out, because then the fuse has been lit on this powder keg that's loaded with nitroglycerin, and it's going to explode, and it's going to explode violently.
So are you saying that this whole system, as it starts to fall apart, is going to be really fast or a slow decline?
Well, I can tell you this. I don't know if it's going to be fast or slow. I know when it happens, it's not going to be consummated overnight, and it's going to be such devastation. And I don't say this using hyperbole. I'm very sad to say this to you, but there's going to be such devastation, such as the world has never seen. And I, for one, I would like to bring it on sooner rather than later, because the longer we go, the longer the Bank of Japan owns all of the bonds and all of the assets, the longer that occurs, there's much more greater unwinding that has to occur between asset prices and the level of economic growth. the longer the ECB stays with this negative lending facility, the more distorted asset prices become. The same thing with the Federal Reserve. The longer they stay virtually at zero, the more distorted asset prices will become from underlying supportive economic growth. So I'd like to get this unwinding back to reality occurring sooner rather than later. The longer you wait, the more violent it will become, and the worse the devastation that will result.
Is this going to be worse than 2008?
Oh, God. It's going to be much worse than in 2008 we had a over leveraged banking system, but we had the federal government was not over leveraged at all. Really, it was mildly over leveraged. You had an over leveraged consumer and an over leveraged banking system, and it was primarily in the United States and to some degree in Europe. And now you have not only the banking system, which is somewhat better leverage, but still high leverage compared to what they were, years and years ago. They used to have 6% cap ratio. It used to be much higher. But banks are still leveraged, and believe me, they are over leveraged. Don't listen to any of the reports about them being overcapitalized. They're overvaluing their assets. They're over leveraged. The consumer has a record amount of debt. There's a record amount of corporate debt. But here's the big problem. All of the sovereigns now are over leveraged. Our debt to GDP was 30-40% in 2008. Now it's over 100%. And the same thing in China, and the same thing in Japan, same thing in Europe. In other words, I'm saying to you, here's the problem. In 2008, we could take on a tremendous amount of leverage on a government level, on a state level. We could lower interest rates from 5.25% to 0. And we can blow up the Federal Reserve's balance sheet from $800 billion to $4.5 trillion. That's where it is today. If we have another recession now, as opposed to 2008, what are we going to do? We can take interest rates down to 0. That's it. That's pretty much where they have to stay, unless they want to take them negative and outlaw cash, which is something that they might very well do. But the Federal Reserve already has a $4.5 trillion balance sheet. And the federal government has a debt to GDP over 100%, 103% debt to GDP. So there isn't much room for them to maneuver. That's why I think 2008 is absolutely a walk in the park, a warm-up to what's going to happen not only in the United States but across the developed world.
Michael Pento, thank you for being on the X22 Report Spotlight. I appreciate it. Thank you very much.
Thanks for having me back, Dave.
All right, thank you.